Hi there. Welcome to my video on A Random Walk Down Wall Street by Burton Malkiel. This book is a classic in the world of investing, and it provides a unique perspective on how to approach the stock market. Burton Malkiel is a well-known economist and writer, and in this book, he introduces the efficient market hypothesis, which argues that the stock market is highly efficient and reflects all available information. This has important implications for investors and how they approach investing. In this video, we'll explore the concepts of the efficient market hypothesis, investment strategies, and behavioral finance, and how they relate to A Random Walk Down Wall Street. We'll also provide some real-world examples to help illustrate these concepts and provide you with a deeper understanding of the book. Whether you're a seasoned investor or just starting, A Random Walk Down Wall Street has something for everyone, and we hope this video will inspire you to learn more about this fascinating topic. So, let's get started. The efficient market hypothesis. The efficient market hypothesis is a theory that suggests that financial markets are highly efficient and that stock prices reflect all available information at any given time. According to the efficient market hypothesis, it is impossible to consistently outperform the market by using any particular investment strategy or by picking individual stocks. There are three forms of the efficient market hypothesis: weak, semi-strong, and strong, each with different implications for investors. The weak form suggests that all past prices and trading volumes are already reflected in current prices, so it is impossible to profit from analyzing past prices or patterns. The semi-strong form suggests that all publicly available information, including financial statements, news articles, and analyst reports, is already reflected in current prices, so it is impossible to profit from analyzing this type of information. The strong form suggests that all information, both public and private, is already reflected in current prices, so it is impossible to profit from any type of information analysis. The efficient market hypothesis has important implications for investors. If the market is highly efficient, it suggests that investors should focus on broad-based strategies, such as index investing, rather than trying to pick individual stocks. It also suggests that investors should not try to time the market or make short-term trades based on market trends, as this is unlikely to be successful over the long term. However, the efficient market hypothesis is not without its critics, and there are some who argue that there are still opportunities to outperform the market through careful analysis and research. In the next section, we'll explore some of the investment strategies outlined in A Random Walk Down Wall Street, and how they relate to the efficient market hypothesis. Investment strategies. In A Random Walk Down Wall Street, Burton Malkiel outlines several investment strategies that are based on the efficient market hypothesis. These strategies are designed to help investors achieve long-term returns without trying to time the market or pick individual stocks. One strategy is to buy and hold, which involves buying a diversified portfolio of stocks and holding them for the long term. This strategy is based on the idea that over the long term, the stock market tends to rise and that it is difficult to predict short-term fluctuations. By holding a diversified portfolio, investors can reduce their risk and potentially earn long-term returns. Another strategy is index investing, which involves investing in a low-cost index fund that tracks a broad-based stock market index, such as the S&P 500. This strategy is based on the idea that the stock market is highly efficient and that it is difficult to consistently pick individual stocks that will outperform the market. By investing in an index fund, investors can gain exposure to the entire market and potentially earn long-term returns without the need for active management. Dollar cost averaging is another strategy that is designed to help investors reduce their risk and achieve long-term returns. This strategy involves investing a fixed amount of money at regular intervals, regardless of market conditions. By investing on a regular basis, investors can avoid trying to time the market and potentially earn long-term returns. While these strategies have their advantages, they are not without their drawbacks. For example, buy and hold and index investing may not be suitable for investors who need to access their money in the short term. Additionally, these strategies may not be appropriate for investors who have a high tolerance for risk or who are looking to make short-term gains. Behavioral finance. Behavioral finance is a field of study that examines how psychological biases can influence investor behavior and decision-making. It suggests that investors are not always rational and that emotions, such as fear and greed, can affect their investment decisions. In A Random Walk Down Wall Street, Burton Malkiel discusses some of the most common behavioral biases that can influence investor behavior. These biases include overconfidence bias. This bias occurs when investors overestimate their abilities and believe they can consistently outperform the market. Loss aversion bias. This bias occurs when investors are more sensitive to losses than gains and may be reluctant to sell losing investments, even if it is in their best interest to do so. Herd mentality bias. This bias occurs when investors follow the crowd and make investment decisions based on the actions of others, rather than their own analysis and research. Understanding these biases is important for investors, as it can help them make more informed investment decisions. For example, investors who are aware of their tendency to overestimate their abilities may be more likely to invest in index funds or other broad-based strategies. Similarly, investors who are aware of their tendency to follow the herd may be more likely to conduct their own research and analysis before making investment decisions. In addition to these biases, Malkiel also discusses the impact of noise on investor decision-making. Noise refers to the random fluctuations in market prices that are unrelated to underlying economic fundamentals. Malkiel argues that noise can influence investor behavior and that investors should focus on long-term fundamentals, rather than short-term noise, when making investment decisions. Overall, behavioral finance provides an important perspective on how psychological biases can influence investor behavior and decision-making. By understanding these biases and focusing on long-term fundamentals, investors can potentially improve their investment outcomes and achieve their financial goals. There are many real-world examples of successful investors who have used the investment strategies outlined in A Random Walk Down Wall Street. These investors have achieved long-term returns by focusing on broad-based strategies, such as index investing, rather than trying to time the market or pick individual stocks. One of the examples is John Bogle, the founder of Vanguard and a pioneer of index investing. Bogle believed that it was difficult to consistently beat the market and that investors would be better off investing in low-cost index funds that track broad-based market indexes. Today, index funds are one of the most popular investment vehicles, and Vanguard is one of the largest investment firms in the world. These examples demonstrate that the investment strategies outlined in A Random Walk Down Wall Street can be successful in the real world. By focusing on long-term fundamentals, diversification, and low-cost investments, investors can potentially achieve long-term returns and reach their financial goals. In conclusion, A Random Walk Down Wall Street provides valuable insights and guidance for investors looking to navigate the complex world of investing. The book argues that investors can achieve long-term success by focusing on broad-based, low-cost strategies that track the market and avoid trying to time the market or pick individual stocks. The book also highlights the importance of understanding the efficient market hypothesis and how it can influence investment outcomes. By recognizing that market prices reflect all available information, investors can avoid falling prey to common investment myths and focus on long-term fundamentals instead. Moreover, the book discusses the impact of behavioral biases on investment decisions and provides strategies for overcoming them. By understanding these biases and focusing on long-term fundamentals, investors can potentially improve their investment outcomes and achieve their financial goals. Thanks for watching.